Okay, we're going to get started, ladies and gentlemen. This is Jamieson with Perpetual Wealth Systems. I want to thank you guys for coming on the call tonight. Just to give you a heads up, we will have some time for a couple questions here at the end of the presentation. And very excited to have you on the call tonight. We are going to talk about some exciting things. The first thing we're going to talk about is why this thing isn't working. Here we go, we're in business. Okay, what we're going to talk about tonight. Number one, and first and foremost, in the whole concept of the perpetual wealth system is the traditional personal financial model that we've all been taught since we were 10 years old is absolutely set up for us to fail. It's set up for banks to get rich, for Wall Street to get rich, and for Uncle Sam to get rich. It's not designed for you and I to get rich. So we need to take some serious steps and really rethink the financial model that we've been taught for generations now. There's an absolute better system, and I'm going to be able to prove it to you tonight. I kind of equate the current financial system that we've all been taught. It's kind of like trying to go up to the top of a stairwell, but doing it on an escalator that's going backwards, or going down, I should say. It's going down, you're trying to go up. I was at the mall the other day with my youngest son, and we were heading up an up escalator, and there was a guy that passed us going on the down escalator. And he decided that he wanted to go back up, and rather than just go to the end and jump on, he decided he was going to go against the grain, and he did that, and he got to the top, but he worked hard. He pumped awful hard, and I'm telling you, it was just much better if he could have went with the tide. And that's exactly what it's like when you're trying to create wealth inside the current financial system. We're going to give you a way that's going to be very easy for you to create wealth and go up with the tide, up with the steps, if you will, instead of against it. We're going to show you a way to retire 10 years early, maybe more, if you have any need to retire and you want to retire. You're going to have more options because you're going to control more money and have more access to your capital. I'm going to show you why a 401k combined with mutual funds are an absolute recipe for disaster if you're trying to retire. That's part of the old broke financial model that's gotten a ton of us into trouble, that hasn't made anybody rich except for Wall Street and the banks and Uncle Sam. We're going to show you a different method on how to create wealth. We're going to focus on the 4 wealth drains that are robbing you month after month after month. And you know what? Most of you don't even know about certainly 3 out of the 4 you're not even really paying attention to. And what it does is the 4 wealth drains enable you to lose most of your wealth month after month after month, and you don't even realize it. Meanwhile, you're chasing a rate of return inside some retirement account or some investment account, and all of the other money is bleeding out the back door. It's kind of like a magic act. You're so intent on paying attention to that right hand, and in that right hand is your 401k and your investments. In the left hand that you're not paying attention to, that you're not looking at, that's where all the money's being stolen, and we're going to show you how to put a stop to that. Once you plug up your 4 wealth drains, or at least slow them down dramatically, you want to use that money to fill up your 5 circles of wealth. And if you can plug up your wealth drains and fill up your 5 circles of wealth, you're going to guarantee a bunch of money for you and your family for generations to come. Because at the end of the day, that's really what we're talking about, is how to create tax-free, when possible, generational wealth. And that's very possible, but you're going to have to use a different system than you've been using in the past for most of you. I want to prove to you why every family needs, and every small business needs, their own bank. I don't mean a new bank that you can go bank with. I mean your own pool of funds that you can treat that cash like banks have been treating money for centuries and create wealth automatically and systematically. I'm going to show you how to do that. I'm also going to show you why pie charts given to you by most traditional financial planners are a sucker's bet that are based on, those pie charts are based on what's called modern portfolio theory that really is not so modern anymore. It came along in the 1950s, and it basically said, hey, for a balanced financial chart, you need to have so much in big cap stocks and bonds and mutual funds. You need to have so much in small cap, so much in international. And you know what? That financial model doesn't work anymore, and yet, unfortunately, financial planners are still using it, the vast majority of them. And the reason it doesn't work is very simple. Nothing is the same today as it was back in the 1950s. I mean, in the 1950s, it would take you days, if not a week, to get trades done in the stock market. Now they're literally instantaneously in splits of seconds. And that's just one thing that technology has changed. Now we're also much more of a global economy. We're much more intertwined. If we sneeze today, Europe feels tomorrow. Japan sneezes tomorrow. We feel it the next day. So it wasn't like that in the 1950s. It took weeks and weeks for economies to react to things. Now it's instantaneous in the days of instant news. So we need a different way to create wealth, and pie charts aren't it. All right, we're going to show you why most of your finances and your retirement accounts are in trouble. They're not earning what they should earn. They're sometimes losing massive amounts of money. And I know a lot of people listening to this call, or if you're listening to the recording after the call, are just frustrated and you're looking for something different. And those something different exists. You just haven't been taught up until this evening, most of you. We're going to show you how to find out if you're in a retirement danger zone. If you are within 10 years of the time you want to retire, you're officially in a retirement danger zone. There's a lot of things that can happen to you during that 10 years prior to retirement that if things aren't done properly, can delay your retirement for years and years, if ever. All right, so we want to make sure that doesn't happen. We also want to make sure you don't want to outlive your money, or your income. And that's one of the fact that's the top fear in America today, based on a survey I saw off of CNN about a few weeks ago. That's the top financial worry that people have, is outliving their money. You also want to make sure that if you've retired, or when you retire, that you only go back to work if you want to go back to work. Now, when I see older folks working at a Walmart or McDonald's, I don't automatically assume it's the worst case, but I know most of them aren't there for choice. They're not there because they want to get out and do something and be productive and just make a little side money, but they don't need the money. Most of them need the money. They've either retired from their current or their first career, or they retired from their first career and now had to come back because they lost a lot of their money during 07 and 08. And I only want you to work if you want to work. If you want to retire, I want to show you how to stay retired. And here's a tip. If most of your money's in mutual funds, that's a surefire way to make sure that you're probably not going to stay retired. It's going to greatly diminish the chances of you staying retired. All right, so who am I? A lot of you guys already know who I am. Some of you don't. My name is John Jamieson again. I'm the author of the Perpetual Wealth System. We took that to #1 bestseller on Amazon, and I would highly recommend you pick it up. This presentation isn't about selling a book. It's about much more than that. But it is a great place to start. I've gotten a lot of compliments on the book, so I hope you pick up a copy. I've got over 23 years of experience in finance, business, real estate. I've just been very fortunate to find something I liked at a very early age and jump into it with both feet. It's been very good to me. Right now I've got clients in many, many states and in Canada. I run multiple businesses, and frankly, those businesses were just an idea at one time. All of them started from a thought and a shoestring, and they turned into very successful ventures because I got a lot of education and I just wanted it. And several years ago, I decided, you know what, I want to take what I know and share it with the marketplace and show people that, hey, there's different options available out there. If you can be juvenile delinquent and high school failure that I was, and a college dropout, and go on to make a whole bunch of money, have a bunch of fun, and influence a bunch of people's lives, anybody out there can do it. So that's what we're going to talk about tonight, is how I can help you and how my company can help you grow and protect wealth. Talk about some fears. Here's some more fears that we have. #1, we talked about, fear of outliving our income. How about fear of paying for college education? That has become a bigger fear as years and years go by, because the cost of education is staggering. And in my own model, I think it's become an absolute scam and a sham. I think it's been watered down so much that now a bachelor's degree isn't good enough, so now you have to go, instead of 5 years or 4 years, now you got to go for 7 or 8 years, and it's just a big way to bilk money out of you. So if you do want a college education, or you want your children to have a college education, how are we going to pay for it is a big fear. Right? Fear of never being able to retire. We talked about that. How about retired and having to go back to work? If you want to go back to work again for choice, that's fantastic, but to go because you need a paycheck, we don't want that to happen. How about fear of losing most of our money in bad investments? I know for a fact that happened to tons of people back in 07 and 08. Many have never recovered, or they're only finally starting to recover, and it's a shame. It didn't have to be that way. There's other things they could have done with their money to reallocate it, to really protect it and grow it. We're going to talk about those today. Fear of illness and sickness, not only because of the illness and sickness, because of the money that it's going to rob us. If you ever had to have long-term care for a loved one, you know what that can cost, or have a nurse come in, you know what the cost of that is. And there's ways that you can combat that and, have not get killed every month after month after month because of a long-term care situation. And most people's plan for dealing with long-term care is a hope. It's a wish. And we don't really care for those. We've got a very structured plan that will help you with long-term care. And it's not a traditional long-term care insurance policy. Those are very expensive. We don't even offer them. But we do offer some things that we find are pretty tremendous in lieu of those. All right, second last two. Having to rely on relatives to help us with our money. Nobody wants that, and we certainly don't want to lose our dignity. It's all about having dignity through our lives and having choices and options. Oh, listen, I want to go on vacation for 2 weeks or 3 weeks. I want to spend the summer somewhere else. And you can only do that if you've got steady, predictable income and assets. And we're going to show you how to take your current asset base and grow it exponentially. All right. The biggest problem of all, we alluded to at the beginning, the basic personal financial model we've been following is absolutely broke. Makes everybody else rich but us. And there's too many Kool-Aid drinkers out there in the financial industry. That's all you see is the traditional financial model. And the traditional financial model basically looks like this. That green circle represents income coming into your life over your lifetime. We're told put 10% away. We're failing miserably with that. National savings rate is less than 4%. Of the 10% that you're supposed to put away, put it inside your 401k, then put it in mutual funds, and the stock market's going to return to you 8% over the long haul, blah, 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 all of which is garbage. Meanwhile, when you're trying to put away your 10% but failing at it and only doing 4%, don't worry. If you need something like a car or equipment, or you want to buy a house, excuse me, or you need some credit, use credit cards, and the average American now, well, they're only putting away 4%, is paying out over 40% of their income gone to payments. So in that business model, folks, that traditional business model you see on your screen, who's getting rich with that business model? The banks and Wall Street, because what money you are putting away is all going into Wall Street, and the banks are picking up everything else with all the other things that you're paying on for the rest of your days. So what if we did something different? What if we just recaptured that money flow? Excuse me, the money that you're currently paying out, what if we could recapture that and actually become the bank ourselves? What if we control the pool of funds that we could use as a bank? So instead of putting away 10%, what if we could put away 40 to 50%? In other words, 40 to 50% of our money that's currently leaving our lives stays in our lives. Ladies and gentlemen, that's a game changer. You know, Benjamin Franklin, a very wise man, got very famous for a lot of reasons, but one of his famous sayings was, "A penny saved is a penny earned." And he's absolutely right. So if a penny saved is a penny earned, how is $300,000 saved? Would that be $300,000 earned? You better believe it would. And that's what we're talking about. We're talking about hundreds of thousands of dollars over your working lifetime, some of you millions of dollars over your working lifetime, by simply reversing money flow. And you be the bank and loan out the money on these different things. Now, I understand most of us can't loan out on all those things right away. We don't have enough capital put aside to do that. So how do you eat that elephant? One bite at a time. Maybe you start with a car or half a car. We're going to show you in a minute why you're better off buying your car than funding your 401k, which I know sounds ridiculous, but I'm going to prove it to you with fifth grade math. So reverse our money flow is part of what we do here at the Perpetual Wealth System to maintain those payments inside of our lives instead of leaving our lives. Okay? So if I told you I was going to give you $25,000 and you had two things you could do with it, you had to pick one of the two things, and you had to pick either buying a car or funding your 401k, and the choice that you made had to be the best choice for you for your retirement. In other words, it had to be a good investment. Which would it be, a car or a 401k? Well, of course, a 401k, well, you know what? That's not true. If you buy the car correctly and use volume and velocity like I'm going to train you on, you're better off to buy your car than fund your 401k. And you know what? I'm going to prove it to you here with fifth grade math. Hold on one second. Let me pull up a blank Word document, and let me get out a digital pen. You're going to have to excuse my writing because I have to use my cursor at the bottom of my laptop, so it's going to look like a second grader did it, but you'll get the gist. Line down the middle. Over here, $25,000, we could buy a car. Or the other choice I gave you was take the $25,000 and do a 401k. Let's take the $25,000 into the 401k first. Let's put $25,000 in it. And let's say it's going to go in mutual funds, in the stock market, and 5 years later, we didn't put any more money in for this example. So 5 years later, that $25,000, well, let's say it's grown by over 30%. And not 30% annually, but gross 30% over 5 years. Now, this is Disneyland kind of numbers, folks. You go back and show, you look at your last 5 years of your 401k statements, take out the new money that you put in it to find out what you started with 5 years ago. Tell me how much you'd have today. Tell me if it's gross 30% over 5 years. Probably nobody listening to this call or watching this video, maybe 1 out of 300. So those are Disneyland numbers. But let's give it the best case scenario. You made 30%, over 30%. So in essence, you made $8,000, let's say, for this example. In 5 years, you're $25,000, added $8,000 to it, so now you got $33,000, and that's great. But the problem is, what I just shared with you, it's only one sliver of your financial pie. Take your round financial pie, this is supposed to be round, okay? What we're talking about when we're talking about your 401k investments or your IRA is just a sliver of the pie. What about all this stuff? These are all money's draining from you here, okay? So, because you didn't have any money because you put it all into your 401k because that's what you were taught how to do, at the same time you funded the 401k, you needed a car. You just did, okay? So you didn't have the money, so what did you do? You financed it. And you went out and you bought it. Now, don't tell me you leased and that's better. Don't tell me you paid cash for it because you're going to see it almost doesn't matter. Either way, you're losing your shirt, right? The only way to make money on this car is to do it the perpetual wealth way. So let's not go there yet, though. Let's talk about what you did do, what 99.99% of people are doing out there. You financed it. So you went to the bank loaned you $25,000. Same 5 years go by, you took out a 5-year car note. Right? So it's 5 years later. What's your car worth now? That $25,000 car worth about $5,000. So you paid back your $25,000. At least it's paid off. You paid back $5,000 of interest. So you paid back a total of $30,000 left your life over that 5-year period back to the bank, and you've got a $5,000 asset to show for it. How much did you lose over here? You lost $25,000. But on this side of your life, you made $8,000. So you deal with negative numbers. You take $8,000, add it to the negative $25,000. What'd you do? You still lost. You're still negative $17,000 for that 5 years. By the way, you probably had a second car, didn't you? You might have had a third car. So you can see, guys, that on this part of this little pie, you made $8,000. But another part of your life, you got absolutely destroyed by this automobile, and you probably have 2 or 3 cars. The fact is, most Americans will spend way more money, which means lose more money, on automobiles than they're ever able to put away for retirement. So what if we just got the losses that you take on automobiles under control? Would you or would you not create much more wealth for yourself? The answer is absolutely you would. So how would you do that? Well, instead of putting the $25,000 in the 401k and making payments on a car, why don't we take the $25,000, fund our own bank with it, and you're going to put it in a very specifically designed account we're going to talk about here in a little while. Let's say we fund that particular account and we borrow out $25,000, but it's an account that we control. It's our money we're pre-funding. And let's set a payment up back to ourselves, the same payment we would have had to pay Bank of America or Ford Credit or whoever. All right? So if we did that, let's go 5 years in the future. What happened? Well, now we've been making the same payment we would have had to pay Bank of America, which means that $25,000 we have recaptured. Why doesn't the timestamp want to come off here? Well, I guess we're going to have to live with it for tonight. I'll keep messing with it, see if I can get it to go. But okay, so anyways, let's say we put the $25,000, we bought the car, and we made payments back to ourselves. So we recaptured the $25,000, that's back into our account. Okay. We paid ourselves back the $5,000 of interest because why not? Someone had to make it, so you're going to pay the bank anyways. You pick it up, which means now you've got $30,000. The account that we have it set up with, they paid us another $5,000 in growth. So all of a sudden, guys, we've got, well, let me try something. There we go. Okay. That worked. We're back. Let me get my pen back. Okay. So we've got got our $25,000 back. I apologize for the technical glitch. We picked up $5,000 worth of interest. We picked up another $5,000 of growth from the company that we set this up with. So we have $35,000 in liquid cash, which is tax-free because of the account we set it up in, which we'll explain in a little while. And we've got our $5,000 car. So we've got $40,000 worth of assets. So the amount of massive money we lost on that car, guess what? We didn't lose it because we used interest volume and interest velocity we're going to talk about here in a minute. And we became the bank, and we actually made money on our automobile. Now, in the first example, we lost $17,000. That assumed that your 401k made $8,000. What if it didn't make any money during that 5 years? What if it broke even? Now what was your total loss in your world of all your finances? You lost 25 grand. What if it was down 30%? So your $25,000 now goes down, let's say 8 grand, which is more than 30%. So now what's your loss? Well, instead of losing $25,000 in your life, you lost $33,000. See the point, guys, the 401k and putting it in mutual funds, your money is going to go up and down, up and down. We don't know what's going to happen with that. Right? This happened automatically and systematically month after month after month. We can set our watches by it. Predictability. Now, how we could create some more wealth is what we call interest velocity. So let's just say I started making payments for a couple years, and I've got $10,000 back in my account. Before my 5 years is up, I've got another 10 grand because I've captured the payments because I'm the bank. Couldn't we take that $10,000 and loan it to ourselves on something else? Maybe we want to pay down our house. Maybe we want to pay off credit cards. Maybe we want to loan the money out to somebody else to create a very safe, secure loan. I'm not going to talk about that here, but there's a big multi-billion-dollar world out there called private lending. So now all of a sudden you've got the original revenue stream because you're still making a car payment back, and now a couple of years in you've got another $200 a month revenue stream. That's called velocity of money. So now the money is going to pool quicker over here. What happens when you get something you can do something with? Maybe it's another 10 grand. What do you think you do? You guessed it. We're going to velocitize that money back out and create another revenue stream. Guys, this is what banks have been doing for centuries. All right, we're going to talk more about that. So this is how you can actually be better off buying a car if you use volume and velocity than funding your 401k. Very simple, 5th grade math. So let me do this. Let's see if technology can cooperate. Let me erase all drawings. I think we're in business. Okay. Okay, so that's going to show you that you need to start thinking differently about money. Don't buy into the party line, okay? That's very simple 5th grade math. Go ahead and do the math yourself. It's going to come up the same every time. 4 massive wealth drains in your life. They are taxes. Biggest single expense people pay, income taxes, along with all the other taxes we pay, and yet most people have no idea how that system works. They have no idea how to create tax deductions, no idea how to run a small business to create deductions and create wealth. We show people how to do that. That's going to stop one of the 4 massive wealth drains or certainly slow it down. Second wealth drain, interest and fees paid to banks and outside lenders. That's massive amounts of money over your lifetime. We can stop that. Number 3, market losses. Did you know that you don't have to give your money to Wall Street? Did you know that you don't have to lose money consistently? Did you know, frankly, you don't ever have to lose money? There's things you can, money you can put your, in products into, or sorry, products you can put your money into that are guaranteed, that don't lose value, that are contractually guaranteed. Those exist, but because the financial community is pretty much controlled by banks and Wall Street, they don't really want you to know that these things exist. They want you to be happily ignorant, know how to be a borrower, but never be a lender. They don't want you to know there's other things you can do with your money besides put it on Wall Street. So what if you never lost another dime, or if you'd never lost any money in the stock market? Do you think you'd have some more money? I can hear the nods across the phone. Of course you'd have more money. Now, last but not least, something that almost nobody talks about besides us, because nobody else has a plan to defeat it, depreciation on big-ticket items. I showed you a car. Most people have 2 cars. Some of you guys have 3. Some of you guys have boats. You've got laptops. You've got office equipment. You've got business equipment. You've got machinery. And you lose money on all of it year after year after year. Well, if you control, who makes money on all that stuff? The banks and the finance companies. So if you controlled your own banking pool of money, and bought those things and created payments back to yourself over a scheduled period of time, the same way you're paying off banks, you're going to create wealth automatically and systematically month after month after month. So those are 4 wealth trains. There's more than that, but those are the 4 massive ones. So let's go back to banking. I alluded a little bit to it here when I was doing the handwritten stuff. Banking's been around for thousands of years. From the time you could take an ox into the temple, you could get a loan or you could pawn it. You could walk out of there with some money in your pocket and come back and get your ox later. Any business model, I submit to you, that's been around for thousands of years, it's a good business model, ladies and gentlemen. It makes sense. The problem is, I've already alluded to, is we've only been taught to be borrowers. We know about credit scores. We know about ratios, but no one's ever taught us how to actually be the lender and how to create wealth by taking in payments. It enables you to make money in good and bad times. When you see banks get into trouble, it's because they violated the rules of banking. They've leveraged too much. There's what we call fractional reserve banking. And basically, for real basic math, if you give a bank $1,000 to put on deposit, Uncle Sam says they can loan out about $10,000, which is great for the banks if everyone makes their payments, or if most people make their payments. They create an incredible amount of wealth. But the problem is when a lot of people don't make their payments, like we've had about 7-8 years ago, and now we also had about 25-30 years ago. About every 25-30 years you have some form of a banking crisis. It's because the banks go away from core banking and they try to be investors, and they invest in derivatives and all kinds of crazy stuff that gets them in trouble. So when banking is done properly and it's not leveraged to the hilt, it's systematic and automatic. Think those payments come in month after month after month. Money pools, you loan it out again. Then more payments come in month after month. It's why lenders make boatloads of money and why it's been around for thousands of years. We're going to show you how to control your family's financial future by being the bank. Never be a slave to the bank again. Never worry about if they're going to make you the loan. When you control the money, you control the loans. We're going to show you the 4 massive wealth trains by using your own bank. Think about what we did with the car. The car didn't really do anything with taxes, although all the money that's inside the account is tax-free. But you picked up the interest that you normally would have paid the banks. You recaptured depreciation, that massive depreciation that you would have lost, and you didn't lose any money in the market during that time. So you plugged with that simple transaction 3 of the 4 wealth trains, and all the money that's growing inside that account, it's tax-free. So you also worked with the 4th wealth train. Once you fill up you stop your 4 massive wealth trains, and we talk about the 5 circles of wealth. We're going to talk about those a little bit more in the future. And guys, real quick, interest volume and interest velocity. You need to understand what these are. Interest volume is how much of any payment that you pay is actually going towards interest and how much is going towards principal, regardless of what the interest rate is. So let me illustrate this. You take out a 30-year mortgage. You got a nice 5% interest rate. Right? Let's say the payment's $1,000 and you start making your first payments on it. About $900 of that payment is going towards interest. So in other words, out of your $1,000, 90% of it is going towards interest. That's called interest volume. It's front-end loaded amortized interest. That's what happens with those types of loans. Now over time it eventually reverses, but it takes many years for that to happen. Meanwhile, you're getting bled dry. And what happens probably a few years into it, you either refinance, because we've all been taught that's what to do. You refinance when interest rates go down. Or maybe you bought another home and you needed to take on another 30-year mortgage and you went to the top of that amortization schedule. That's interest volume. Banks don't care what the interest rates are. They care what their interest volume is. Velocity of money. This is speed of money. So in other words, when I showed you that example of where money's pooling back after you bought your own car and you made payments back to yourself, as money pools back in that account, you loan the money back out and you create another revenue stream. Money pools in quicker this time. What do? Loan it out again. Another revenue stream. Pools even quicker. Loan it back out. Velocity is the speed of something. Now, Walmart and any retail establishment uses it, but let me tell you an example of velocity that you almost all can understand. A lot of people listening to this at one time have either waited tables or been a bartender. So if you have 10 tables one night that you're watching, and all 10 of those tables, they all get turned once, how much money does the restaurant make, and how much money do you make in tips? Well, what if you turned them twice? You could turn those tables twice. Would you make more money? Would the restaurant make more money? Same amount of tables, but you turned them twice. How about you turn them 3 times? See, that's the velocity. That's the speed of something. Well, a bank's main commodity is money, and you can be on the receiving end of the money and the velocity instead of the paying end. All right. So volume and velocity are 2 huge terms. It's the way banks really create wealth. So where do I pool my money? John, you've sold me on this banking thing. I want to be my bank. I want to have a small business bank and a personal bank. How do I do this? Where do I pool the money? Do I just start writing checks out of my checking account? The answer is you could, but if you're going to do it, might as well do it right and put your money where major banks put a lot of their money, where Fortune 500 companies put a lot of their money, where family dynasties put a lot of their money. Where is that? It's not in a 401k or an IRA. Many of you guys already know because you've seen me speak on different things. It's a properly designed whole life insurance contract. And you have to underline properly designed because 98% of the policies out there are not designed to do what we describe. We're experts at building these. We work with 100-year-old plus companies who embrace this concept, and we build these policies specifically to bank with, to be a bank, to treat with a pool of funds. You do it for a lot of reasons inside of an insurance policy, which we're going to cover. What I just told you about putting money in whole life insurance policies, I realized goes against traditional financial teachings. I was anti-whole life insurance for 20 years because I was taught wrong, because the person that taught me didn't really understand that you can build policies a number of different ways. They just heard whole life, more expensive, buy term and invest the difference. Ladies and gentlemen, the buy term and invest the difference myth, all you need to do is turn on your television to see how that's working. Okay? You see all the end-of-life insurance companies out there. Alex Trebek, Colonial Penn. There's several different companies out there that have been on for a decade. What are they selling? They're selling end-of-life $10,000 or $20,000 death benefit policy. Why? The people that buy those don't think they've got enough money to bury themselves and don't want to burden their families. That's why most people buy those policies. So they've worked their whole lives. They, in theory, bought term insurance that expired years ago because now they're older. They invested the difference, and they don't have enough money to bury themselves. Now, I'd submit to you, just to be able to pay the marketing budget those insurance companies pay, they've got to be selling millions of those policies. All right? So buy term and invest the difference is a myth. It doesn't work, never has worked, and it never will work. When you understand all the benefits of a properly designed whole life insurance contract, you start to realize that no wonder banks put a ton of their money there. No wonder Fortune 500 companies put their money there. So I'd submit this to you. If all the financial gurus are right that say, oh, no, it's a lousy place to put money, why, follow money. What does money do with money? Well, banks have 20 to 40% of their what they call Tier 1 core assets. They've got that in whole life insurance contracts. There's hundreds of billions of dollars put in there by Fortune 500 companies. And the family dynasties like the Rockefellers and the Vanderbilts and all those famous names you've all heard of, folks, they've been using life insurance policies for generations to grow and protect wealth. Why doesn't the average person do it? Because we're too busy putting money in 401ks and IRAs thinking that's the way to build wealth. Who taught us to do that? The banks and Wall Street did. We talk about the foxes are training the chickens. All right? No wonder we can't get ahead. The foxes are running the show up until now. So, again, where does money put money? Bank of America. I put this together at $17 billion of their money in high cash value life insurance. $12 billion JP Morgan. So you get the point. Billions and billions of dollars, and that's just scratching the surface of the money that's in whole life insurance contracts. So ask yourself, wherever you have your money, most of you guys have it in a 401k or an IRA, is it doing all of this? Because what I'm just about to read to you happens inside of a properly designed whole life insurance contract. And there's no other account on the planet that has all these benefits. Number one, is your principal guaranteed not to go backwards? Right? In other words, whatever cash value you start with, and you're going to start off with very high cash value if this is done properly, whatever you start off with will never go backwards. It's got to go forward year after year after year. Now, some years it'll go forward by quite a bit. Some years it'll go forward by hardly at all. But it will go forward, and it can't go backwards. So when your 401k lost 30, 40, 50%, when it does it again, understand that's a choice that you're making now after you understand this. There's different things you can do with your money to contractually guarantee your money. Does it grow every year without fail guaranteed? Your 401k, no. Yes, with a properly designed life policy. Do you have tax-free growth and dividends? The answer is yes, inside of a life policy. Do you have access to the money at any time, at any age, at any time, for any reason, with no tax and no penalty? Inside a whole life policy, yes, you do. Inside your 401k, no dice. You might have access to it, but there's a bunch of hoops you got to jump through, and if you don't jump through them just right, penalty, tax, etc. Very difficult for creditors to attach and seize this. I'm not saying it's impossible, but it's another layer of protection for you high-income, high-net-worth people that you need to take a look at to protect your assets. And by the way, if you're not high-income, high-net-worth, I got clients who are putting into this monthly. They might even put just a few $100s a month in. It's for everybody. that is bringing in money that wants to grow and protect it. At least, reach out to us, see if it's going to be a fit for you. It can be used as your bank. So when you go to buy that car, borrow the money out of your life policy. Now, to be fair, that example I used before, if you put $25,000 in a property design whole life policy, you cannot borrow out $25,000 day one. Right? You can probably borrow 75 to 85% of it, depending on certain issues. Okay? So you'd have to put a little bit more than $25,000 in to be able to borrow the whole $25,000 out. But what happens is, years later, you've got way more money in that account than you've put in. So it's basically sowing some seeds, giving up access to a little bit of your money today for a lot more money in the future. It's prudent, it makes sense, which is why all the money goes there. Right? You've got total control for what you want to use your money for. There are no restrictions. Even self-directed IRAs that I teach all over the country, there's restrictions on what you can do. And if you violate those restrictions, you put that account at risk for all kinds of penalties and taxation. For you high-income, high-net-worth people again, you can put in a ton of money inside these things year after year after year. If you're putting money inside qualified plans, whether it be a SEP, 401k safe harbor, they're usually limited to about $50,000, give or take. I've got some plans putting in hundreds of thousands of dollars annually into these policies. You can do the same thing, or you can put very little in, but you're in control. There's not the same restrictions that there are on qualified plans. Money passes tax-free to your heirs, and you leave more money behind than you have in your account. So, as an example, if you took $10,000 inside your 401k and you get hit by a bus, your family gets the $10,000. You put $10,000 reallocated inside of a property design life insurance contract, you get hit by a bus, your family's going to get hundreds of thousands of dollars by simply reallocating that money inside of a property design life insurance policy. Okay, you choose the repayment terms on any loans that you borrow out. None of this you got to have it paid in 5 years or pay so much a year or there's taxes and penalties. Folks, you're in control. And what you're going to find once you set these up is you're going to want to pay back more interest because you're the one that's going to be the benefactor of the more interest that you pay into the policy. I won't bore you with all those details here. It's one of those things we'll do on a one-on-one basis and show you how it works. You got guaranteed insurability for life once you're approved for this. Once you've got the policy set up, they can't take it away as long as premiums are paid. No matter what condition you might acquire in the future, you've got this in place. Last but not least, you can combine your banking, the money that you use inside your insurance policy as a funding source. You can buy appreciating assets with it. You can combine with real estate. Now, folks, pick up the Perpetual Wealth System. The last 3 or 4 chapters in there talk about a very simple plan of taking money inside a life insurance policy, borrowing it out, buying cash flow real estate, and the amount of wealth you could create with that type of system. Because I'm telling you how to make money on depreciating assets. So if you can make money being your own bank on depreciating assets, how do you think you might do with appreciating assets? You're going to do very, very well. Okay, so you can do that with real estate. You can add it to your business, be your own leasing company with your business. You can make private loans to other people at really strong interest rates and make very safe loans. That's a whole different topic, but understand it's available. Let's talk about the phases of your financial life. There's basically 4. There's your accumulation phase. Typically starts when you first start working. So 20, 25 years old, you get out in the workforce. And that accumulation phase goes all the way till you retire. Let's just say 65 years old. So from 25 to 65, in our example, that's your accumulation phase. Theory says you can afford to lose money during that time because you'll get it back. I say, why lose it? If you don't have to, why lose it? There's other things you can do to either never lose money or very rarely lose money if it's done safely and securely. If you're going to throw it all in the mutual funds and all in the stock market, you're going to ride that up and down average rate of return roller coaster. Right? Your pre-retirement phase, that's what we call a retirement danger zone. That's within 10 years of the time you want to retire. So as an example, let's say you're 57 years old right now and you want to retire at 65. You've got all your money in mutual funds, you are absolutely in retirement danger zone. Ask yourself this: if the market takes a serious downturn, as some people are predicting it's going to, and I'll predict it will, it's going to go down, and then it'll probably go back up, and it'll probably go back down. The only question is when and how much, and you don't want to be the last man standing. So if you're 57 years old and you want to retire in 8 years, and you lose 40, 50% of your nest egg today, what does that do to your retirement plan? Devastates them. So you might be getting ready to retire, but your money's not, because you're still in accounts that give you all kinds of risk. You haven't pawned that risk off on anyone yet because nobody's showing you how to do it until now. Third phase is income distribution phase. You hit your retirement age. Let's say it's 65 and you've done well, you can retire. That's great. But now you've got to have money be produced for the next however long you're going to live. Hopefully 30 years, 20, 30, 40 years. Okay, I mean, with the way they're advancing medicine, nobody knows how long you can live. So let's just say at 65 you think you can make it to 95. That means you've got to produce revenue for 30 years. And if you have a downturn, if you continue to keep your money in mutual funds, and you start taking your money out of mutual funds, and as you're taking it out, the market goes down, that's called reverse dollar cost averaging. See, a lot of us are taught dollar cost averaging. That's during your accumulation phase. And dollar cost averaging simply says that, hey, if you're investing into a mutual fund and it's at $20 a share, and the market goes down and it's only $10 a share, and you're putting in the same amount of periodic deposits out of your check to buy these shares, well, you can buy double the shares. If it goes from 20 to 10, you can buy double the shares for the same money, and when it goes back up, you've got more shares. And you know what? It makes sense. Dollar cost averaging is not a bad concept. The problem is, as with most financial concepts, they never teach you the other side of the coin, and the other side of the coin is reverse dollar cost averaging. So now you're not in accumulation phase, you're in distribution phase, and you're cashing in shares of that mutual fund. So you need $3,000 a month to live on. So you're cashing out shares. Meanwhile, the market's in a steep decline. You need to sell more shares to receive that $3,000, and you're not accumulating them anymore. So the market, so you can see how you can wipe out a retirement account quickly. A few years of serious downturns in your funds, and you're taking out money, money can be wiped out. It doesn't need to be that way. And last but not least, in your legacy phase, that's what you want to leave behind. You know, and whether it be money, whether it be influence, charities, foundations, what do you want your money to do when you leave? And the best way to protect it, that it goes to where it's supposed to go. Now you start dealing with estate plans, you start dealing with estate attorneys, and we have all of those available to us with the Perpetual Wealth System. So we're some of the top people in the country. We want to make sure that your money goes to where you want it to go to whom you want it to go to. Let's talk about the most popular way to save money and invest for retirement in this country by far. That it's the most common. I didn't say it's the best. It's 401k and other qualified plans. Qualified plans simply means that Uncle Sam sets up some very specific rules where you can put in money inside of specifically designed accounts, and you can have supposedly tax-favored status in these accounts. But Uncle Sam makes up all the rules. He qualifies them. That's why they're called qualified accounts. 401k experiment basically came along because companies wanted to get rid of pensions. Pensions, you had to, if you were a company owner, you had to guarantee a certain benefit when people retired. So, okay, you work for us for 20 years, we'll give you $3,000 a month. During the 20 years, we're going to put money away for you as a company. You're going to put some of your own money away, and you're going to have a pension. And we're going to pay you and your wife or your husband $3,000 a month for the rest of your life. Now, the problem is the companies were shown projections the same way you were that, hey, to be able to pay that out, you're going to have to take this money and get such and such a return on it. Well, when you don't get those returns, it means there's not enough money to fund the pension. So when you hear the term underfunded pension, many times it's not that the money wasn't put in. It's the money didn't perform the way it was supposed to. And now what has to happen, if they want to continue to guarantee you that benefit, what does the company have to do? They have to make up the difference out of operating expenses. They don't want to do that. So with the 401k, now it's not called the defined benefit plan, it's called the defined contribution plan. In this way, they've shifted all the burdens of retirement over to you as the employee. You fund a 401k. Some of your employers might contribute to it. Some of you guys are getting matching. Some of you aren't, or you are, and when the economy goes south, you won't. But regardless, you're putting money inside of a qualified plan, your 401k, and it's growing tax deferred. Okay? Meanwhile, they'll tell you, well, you also get a tax deduction when you put the money in there. Folks, you don't get a tax deduction. You get a tax deferral. A deduction is something that I get a deduction off my income and I don't ever have to pay. You do have to pay the tax here. You just have to decide, do you want to pay it now at a known amount with presumably less money, or do you want to pay what most people think are going to be a higher percentage later on more money? And what I mean by that is ask yourself a question. Do you think that taxes are going to go up or going to go down over the next 10 or 20 years? If you think like 99% of the people we talk to think their taxes are going up, then let me just ask you a very simple question. Why are you agreeing to defer taxes till tomorrow, so what you believe is going to be a higher amount, rather than pay the tax today and get it out of the way, then put it into a tax-free vehicle and not have to pay tax on it again? Now, there is a Roth IRA and a Roth 401k that operates similar to that, but it's still a qualified plan, and Uncle Sam sets all those rules. Right? Who's Ted Dennett? Ted Dennett is the guy who is credited for coming up with the original 401k concept. He's quoted very recently as saying he wants to scrap the whole program. He never intended it to be used the way the government has used it. And typical, the government gets its hand on something and they screw it up. And that's exactly what happened. So even the guy that started the 401ks wishes he could take it back. It's definitely, they've taken the place of defined benefits plans. Now they're defined contributions, right? They call them qualified plans. We talked about that. Most of those qualified plans, the money's taken, put it into mutual funds, put it into the stock market. If you participate in the stock market, you love it because it's money under management. It means wealth and billions of dollars for Wall Street. The dirty little secrets to qualified plans. Here's what they don't tell you about 401ks and IRAs. Number one, who's the qualifier? Uncle Sam is. He sets all the rules. There's $10 trillion right now in qualified plans. Uncle Sam is salivating to get his piece of it. That means he's going to change those qualifications. There's already talk underway. They want to change the age at which you have to start taking money out. They want to start raise the penalty age. So instead, right now, if you take money out before you're 59 and a half, you've got to pay a penalty. They want to make the penalty more and make the age older. In other words, guys, they don't want you taking the money, which means they have designs on it. Some way, somehow, you can believe they're going to try to get their hands on it. All you have to do, if you doubt me, look at the biggest qualified plan in history. It's called Social Security. Now, to be fair, it is set up a little bit differently. Social Security was directly paid into the government account, and they were responsible for it, et cetera, et cetera. But guys, they stole the money. The money was it was supposed to be inside of a trust fund, and if it would have been inside a trust fund, there'd be trillions of dollars in there now. But what did the government do? They started rating it, and they called putting it on budget. They didn't actually say rating it, but they started putting it on budget in the 60s to help pay for the Vietnam War and to help pay for the Great Society. And ever since then, it's part of the budget, and Uncle Sam just put IOUs inside the Social Security Trust Fund. Well, now we're starting to hear, guess what? There's not enough money in there to pay retirees. It's going broke. That's why they took the money. So I don't want to put as very little control as I possibly can in the government's hands when it comes to my money. If you feel the same way, rethink putting all your money inside 401ks and IRAs. Now, if you already have a lot of your money there, you could be saying, well, John, that sounds great, but, I've already got all kinds of my money in there. I'm really there. Now what do I do? Do I pull it all out and pay the tax and penalty? The answer is nobody can advise you to do that. People would be silly. That's something you have to decide for yourself. I will tell you this. There are ways that you can take that qualified money, keep it as qualified money, but put it into products and programs that offer another level of layer of protection for you and offer protection for the money. Okay? And we're going to talk about that a little bit more as we get into it. So if you've got a lot of money inside qualified plans, you didn't get into that overnight, you don't get out of it overnight. Okay? The good news is we do have some systems that will work for you to be able to grow that and protect that money. We'd suggest that you open up your own private pension. See, folks, you don't even need companies to have a pension anymore. You can create your own private pension, right? When you set up a private pension the way we're talking about, you never lose money. Your capital can't go down. You got guaranteed income for the rest of your life. Monies go up every year. Okay? You're not subject to any market losses, right? And you're not subject to the dirty secret of reverse dollar cost averaging, because when you pull money out of these plans, you're not pulling shares out of a mutual fund that are going down. Since the money can't go backwards, you're guaranteed that you're going to have that money year after year after year. You might even be able to set it up where you've got cost of living increases, so your income increases with inflation. Sometimes you can do that. Sometimes it's a steady income stream. But there's all kinds of different ways you can set it up to set up your own private pension. I've got a small presentation for you. Go to perpetualpensions.com. See the website there at the bottom. Now, right now, when you get a chance, go to perpetualpensions.com and watch the brief video I have there. You'll love it. It's going to open up a whole new world, what you might be able to do with qualified money. And in fact, it's also a good place, can be a good place, depending on the individual, to put non-qualified money that you want to set up for retirement, that you want to grow and protect. So go there, check it out. I think you'll like it. You can reach out to us from there. Here's the 5 circles of wealth. And if you can plug up your 4 wealth trains and fill up these 5 baskets or 5 circles of wealth, you're really in the catbird seat. The first circle is investments. These are anything that can go up or down in value. So this is stocks, bonds, real estate, gold, platinum, futures, you name it, like commodities, anything. Those are all investments where you can make a lot of money and you can lose a lot of money. Some other non-traditional investments we teach people about are real estate investment, but doing it a little bit differently, doing it with much more safety, not going to the bank to borrow money, sometimes having free and clear real estate for cash flow. We also teach people how to make private loans, not only to yourself, but make private loans to other people. Once you make a private loan, guys, that's an investment for you. That becomes an asset, just like it does for a bank. That's an income stream. You can do very well with that. Tax liens and tax deeds are a tremendous place to put money if done properly. So that's the investment circle. We want you to have investments, especially depending on your age, but don't believe they only have to be stocks, bonds, and mutual funds. There's all kinds of other alternatives. The guaranteed income circle is, okay, how much can I set my watch by month after month after month that I'm going to receive after I retire? Where do I get guaranteed income? Social Security. Now again, it's underfunded. There's problems with it. I think it's going to be around at least for the foreseeable future. They might have to change it and change how much is going to get paid out, et cetera, et cetera. There's going to be battles to come with Social Security. I don't think it's really going anywhere, but the income that you receive might change. It could be a pension. If you do have a traditional pension that you paid into that you're going to get paid out on. Guys, if you do have a pension, don't live in a fool's paradise that your pension is absolutely safe, because no one really knows. Okay. I come from the city of Detroit, and as we sit here today, Detroit's in bankruptcy. But they're just the biggest one so far. They're not going to be the biggest city that's going to have these problems. They're all over the country. And all the pension holders, of which my dad was one, he's passed away now, it doesn't affect him, but he would have been sick to his stomach if he thought he was only going to receive 40, 50 cents on the dollar for his pension. I've got a friend of mine who is in a trade, has been in the trade for 25 years, and he was told, hey, when you're out, you're going to have, let's just say, $4,000 a month income from your pension. Well, they just informed him that to get that same income, he's got to work another 10 years. Why? Why do you think? Because it's an underfunded pension. The money is not performing the way it's supposed to. They've given the bad news to everybody. Or if you want to retire at the same time, take half of what they said they were going to pay you. So even if you have access to pensions, you need to set up money on your own outside of those programs to make sure that you've got solid income, guaranteed income. That's part of our private pension program. Your life policy, you can take money out of that for life if it's done properly. Okay. Cash and liquidity. You got to have emergency funds available, easy access, or opportunity funds. Someone says that maybe you get into real estate investing. Someone says, hey, you know what? I got this house, a stupid thing. It's worth $100,000, but I just want 60. I want out, next week. Well, if you've got liquid funds to be able to take advantage of that, you can really make some tremendous deals out there. Cash is king. Long-term care and home health care. That's the only circle. If I took that circle out, all those other circles would fall down to the ground and bust. In other words, long-term care or home health care needs can eat up all of your other circles. So we've got some solutions for that don't involve buying a long-term care insurance policy. We might talk to you about asset-based long-term care. We might talk to you about using long-term care riders with a life insurance policy, or possibly even with a private pension program. There's certain annuities you could set up with that have long-term care or home health care needs taken care of on. All kinds of things you can do once you know they're available. And that's what our job is, to let you know they're available and to work with you to get it set up properly. Last but not least, your legacy and your estate. Okay, what are we going to leave behind? We talked about that. That's another circle of wealth. And guys, if we can stop those 4 wealth trains, have all these circles spin nice, oily, balanced, in a nice, oily, balanced way, you've got a phenomenal financial life. And you can really enjoy what life has to offer without worrying about money. Business owners, if you happen to be a business owner and you're paying out a lot of income tax, we have what we call our income efficiency strategy. We've got business owners who are dramatically able to reduce their income taxes legally and ethically, sometimes by 50, 60%. So if you're shelling out a lot of money, you're a business owner and you're shelling out a lot of money, you need to reach out to us to see this strategy. We're not going to talk any more about it here, but it does exist. Maybe if you own that same company and you've got an existing 401k that you're paying into as not just the employee but the employer, and you like this private pension concept. Well, ladies and gentlemen, you can turn that 401k into its own private pension without having all the downsides of a traditional pension plan. In other words, you can really make that 401k do something. You can protect the principal. You can make sure it grows. You can make sure it provides lifetime income. There's ways to do that. Just reach out to us. We'd love to share with you what we can do here at Perpetual Wealth Systems by working with our team of professionals. Guys, we work with some of the top people from all over the country, not just in our office. We went out and found the best and brightest we possibly could to help us set these programs up. So how do we make our money? Real simple, guys. We're a wealth education company. So after we educate you and show you how this stuff works, when you set up programs, we set them up with companies that have been around for over 100 years. These are all multi-billion-dollar companies that are rock solid. We get paid by them when we bring them money. That's what it boils down to. So don't think you've got to pay us anything extra. We want to educate you first. There's no additional fees to dealing with us. And one exception to that is our college planning program. We do work with families to set up college plans, and that's very labor-intensive and time-intensive. And not all of it revolves around putting money into financial products. It's just showing you how to allocate, how to apply for grants, how to apply for loans, working with people to get your ACT scores up, your SAT, all that stuff that goes along to going into college. There is a fee for that, a fee for service, but anything else we do, there is no fee. And by the way, the fee for the college planning, it's the best money you're ever going to spend if you got someone wanting to go to school, because it can dramatically affect how much you pay at any given school out of your pocket and how much you can qualify for grants, loans, etc. I won't bore you with it here, but if you've got a need for that, if the need is pressing or sometime off in the future, reach out to us. We can help you with that. Bottom line is you are our wealth, okay, not selling expensive educational packages. You're our wealth. Long term, by you doing business with us, by you getting the book out there and showing people that, hey, there's a different way to do things. We've done it for our family. We want you to, to succeed with your family finances as well. Why don't you look into this? And directing people to our site, and people do business with us and they call us. That's where our wealth is. It's not an educational package. So that's how we make our money. After we educate you and you say, yes, I like this, I should have done this 20 or 30 years ago, set me up, that's when I get paid from the companies that we put your monies with. So, John, we like what we hear. What's our next step? We want to wrap up tonight. Guys, you should see a 3-page questionnaire. Now, actually, if you're listening to this live, you won't see it right just yet. You can contact us directly, and we'll send it to you. But if you're watching the recording of this, look for the 3-page questionnaire PDF. Print that out. Fill it out. Do it right away, because, there's so many good intentions. Oh, I'm going to get it to you next week, 2 weeks. Next thing you know, it's months. I've got clients, prospective clients that all sounded good, and they just have not gotten around to filling out the form, which means they don't really want to get ahead. So print out the form, fill it out, email it back to us. You can scan an email to Colleen, C-O-L-L-E-E-N, at theperpetualwealthsystem.com, or you can fax it to us, 586-273-1507. Right? We'll reach out to you and confirm our receipt after we get it. Once we have that, take advantage of our free wealth strategy session. Let us take a look at it. Let us build you out a program, some suggestions, and we'll get together with you. You'll have a ton of questions, because this is not meant to be the be-all and end-all. It's just supposed to give you some options that are available to you and let you know that, hey, there's hope. There is something different than what you've been taught, and we can help you set it up. But we also understand you're going to have questions. We're okay with that. I do want to, consider joining our online community. Guys, if you go to perpetualwealthclub.com, perpetualwealthclub.com, and get a copy of my book for free when you join the Perpetual Wealth Club. Guys, Perpetual Wealth Club's $39 a month. There's thousands of dollars literally of training on there that I've already uploaded. We're going to continually add tremendous content and value for our clients there. For me, there's no other way you can. It's less than a cheap cup of coffee a day. I want you to go and check it out and see if it's for you. Give it for 39 bucks. It's not worth a shot. I mean, what do you see? There's 2 videos there. It'll explain all to it. I don't want to sell it to you tonight. If you've got any interest, go watch the videos. If you're not interested after that, you're not what we're looking for at that particular site anyway. That's okay. But do go check it out. If you join, you get a copy of the book thrown in. Right? One other thing, pay it forward. If you like what you saw, do yourself a favor and do us a favor, and do the people you love a favor, and send them the link to this presentation. Just say, I really value your opinion. Let me know what you think. Send this link out to them. All right? Because people out there need help, guys. I mean, we're really fighting an uphill battle. We want to take people and show them how to be on the escalator going up instead of going up fighting the down escalator. And we need your help to do that. If you like the presentation, please, in this day and age of social media, click on any icons we have on here and post and say, hey, great stuff, check it out. Whatever you can put about us, we'd really appreciate it. We really want to get our message out there to the marketplace. So for all you tweeters and Facebookers and Pinteresters and anything else, Google Hangouts, you name it, post us. Tell people to come check out this presentation. It can be a game changer for them. Would you like to Would you like us to talk to your group? We will give presentations all over the country. I don't travel near as much as I used to by design, but I'd be happy to hear if you've got a group, and maybe if I can't do it, maybe I can have one of our other wealth strategists give a phenomenal presentation and talk about these concepts we have here. And sometimes I can do it. So don't hesitate to reach out if you've got a group you'd like for us to talk to. We're interested in chatting with you to see if we can make that happen. Keep in touch with us through our sites. Really, the main site to keep in contact, and it'll get you through all the other sites, is I've got it open here. If you go to johnjamieson.com, John Jamieson, Jamieson, you'll see what that is, guys. It's basically a portal for everything that we do. So you can see we've got Perpetual Wealth Systems. That'll take you to the book site, all kinds of free training on there, videos, all kinds of great stuff. Perpetual Wealth Club, I already told you about that. That's to join our online community and really get first-class inside education. Perpetual Pensions, that's where to go see that training about how to set up your own pension. I work with a lot of real estate agents and real estate investors from all over the country. I've got a very specifically designed site for you guys, so go check that out. Also have another niche. We work with medical professionals. Guys, medical professionals make a lot of money, but you'd be unbelievable how much money they lose in their 4 wealth drains. And then the real estate cash flow machine, if you feel like buying cash flow property here in Metro Detroit, we've got the whole turnkey solution. We've been doing business here for 24 years. That's a niche that we have. If we can help you with that, great. We also, if you happen to have property that you want to sell, we're real estate investors. We buy property all over the country. Just click on that. This is going to be our main portal. It'll take you to anything else that we do. All right, Perpetual Wealth Club, our family of companies. But definitely pick up the book. Join our online community. Do something to really take advantage of what we're doing here. Print off that 3-page form. Get it over to us. And let's see. I want to go to questions. I want to get a couple of them in. Hang on one second. Let me see what we got here. Amy asks if she can roll over her old 401k to a life insurance policy. The answer is you can't roll it over. You can't do a tax-free rollover because your old 401k is a qualified plan. The life policy is not. So, Amy, depending on how old you are, I'm guessing that you're probably still young enough that you'd have to pay penalties. You probably have to pay tax because you put tax. You haven't paid the tax on the money that you put in originally. However, there might be a better program, perpetual pension, a private pension for you might be a better call. What you want to do with life policies is fund those with income. So if you're putting money inside a 401k, let's just say you're putting $10,000 a year inside a 401k, you can take that $10,000, reallocate it inside of a life policy, and grow it tax-free for the rest of your life and use the banking concept and everything else. So there's things you can do, but with existing money, you're limited a little bit. But we've got some tremendous things that will help you, move forward with that old 401k. Timmy, no, hold on. Oh, that's Irene. Irene wants to know how she can use this in her real estate investment business. Well, think of it, Irene. You need capital. So if you're going to buy a piece of real estate and do the rehab on it, let's just say you're going to do that and it costs $50,000 to do it and you've got $50,000 in your own private bank, why not borrow the money from yourself, pay yourself 3 points and 12% interest like you have to pay a hard money lender, make the money on your property, but also have the other monies paying back to the bank go inside your life insurance policy, and that money grows tax-free for the rest of your life, and now you can rotate it out again for your next deal. So think about it. You're not only going to own the properties, you're going to own the bank that's funding the properties. Now, I realize that most people won't have enough money to fund all their deals. Okay, so you got to be able to go out and borrow money if you want to be in the real estate investment business. But if you can use your money for a certain amount of deals, go ahead and use it because you're going to make the money that you make inside the bank and the money you're going to make on the properties. And the same token, if you buy a dog and you lose some money, well, guys, if you lost $5,000 on that project because you botched it, but you made $3,000 inside your bank, you know what? You lessen the loss to $2,000. And that's a great concept to keep in mind. So that's one of the ways you can use. Another thing you can do is the real estate cash flow machine. We show people how to be all into great cash flow properties for about $50,000, and those rent for about $900 a month. And we handle them, the rehab, the management. You just get a check. You send the money, and you receive payments, plus you get deed to the property. So that's one thing we do for people. So we can help you all kinds of ways. Let me see. Brian. Go check out Real Estate Agents Build Wealth. Real Estate Agents Build Wealth. Guys, I've been a licensed real estate agent for, 22 years. And I didn't put near as much money away as I could have because I was always worried about keeping the money tied up. When I started to realize that if someone would have taught me this 20 years ago, I would have put tons more money away in my private bank, had it tax-free, and be in a much better spot. And when things turned down in 07 and 08, I still would have lost money, but it would have been a blip on the screen. Where it really was pretty devastating. I was able to get through it and not have to bankrupt out and still had a couple bucks left, but it was a bloodbath because I had properties here, I had properties in Florida, and these were all leveraged properties that looked like they had equity in them. Well, that's what I learned about leverage real quick. Leverage can go against you. It can go for you and it can go against you. So when in doubt, I prefer that you have paid off properties, and with the low prices of real estate around here, many times people can buy a couple properties. We've got some clients that have 20 properties that are cash flowing like monsters, and they're all paid off. Now, obviously you got to have a few bucks to do that, but that's what's available. Guys, I want to keep our time and be straight with it. We're over an hour. I wanted to keep it right about an hour. So do this. We're going to wrap it up. I want to thank you guys for coming on the call this evening. we're going to post the recording. It'll be up in a few days, so if you want to watch it again or send people to it, we'll let you know when it's on there. We'll send you out a link. And reach out to us, fill out the 3-page questionnaire, set up your free wealth strategy session, check out the book, check out Perpetual Wealth Club, check out the free videos. We got some good stuff. We're really excited that you joined us tonight. We hope we shed some light on some things and gave you some hope and said, you know what, there's a different way to do things. I like what these guys say, but I need to learn more. Right? Thank you so much for joining us again. My name is John Jamieson. I'm the author of the Perpetual Wealth System. We'll look forward to seeing you soon. Thanks so much. Bye-bye.